Hello everyone and welcome to the series Beautiful Business powered by Xero. My name is Kalolo, I'm a Xero partner consultant and I just want to thank you for taking this time to join us today. We hope you find this to be a valuable and an enriching experience. So here at Xero, we strongly believe in the value of bringing beautiful business to the farming and small business industry to assist you in making business decisions to unleash your business's full potential. So thank you once again for joining us today. So in today's session, we'll be discussing how you can feel closer to your numbers. So sit back, relax, and let's get those amazing thinking caps on. We hear time and time again from our customers that they struggle to interpret their financial reports. So if you don't know what your numbers mean, how can you get close to them and really understand what's going on? A lot of you out there have this great visibility over your data, such as your grass growing statistics, your milk production statistics, and even the weights over your stock. This information helps get you closer to achieving your goals and knowing what actions need to be taken. So why can't you obtain this kind of visibility when it comes to your numbers? In fact, this issue can be actually avoided through a bit of financial knowledge. So the good news is that gaining understanding and education over the basics is actually quite easy. And that's where we're here to help. So today, I'm joined with Trudy Ballantyne, Director from the Business Results Group. She's here to help remove some of that unnecessary quote-unquote noise and really help you become more financially in tune with your numbers. Hi there, Trudy. Thank you so much for joining us today. Would you like to introduce yourself a little bit and just give a bit of a background as well?
No, thanks, Kalolo. It's great to be here today. It's the opportunity to demystify numbers for farmers and businesses. I look forward to it all the time. I grew up on a dairy farm in Northland and I've been a chartered accountant for rural-based businesses for over 20 years. I'm based out of Te Puke in the Bay of Plenty now, and while we have all sorts of clients, we do specialise in all areas of the primary sector. So when meeting with clients, you can often tell that they don't understand the numbers that you're talking about. Their eyes glazing over sort of gives you that impression really quickly. So when that happens, I often say, okay, let's just back the truck up and go back to basics. So learning about what your financial statements can tell you about your business is a gradual learning process. It won't happen overnight. But over time, you can learn more about what the numbers mean.
Awesome. Great, thank you so much for that, Trudy. So let's start off with going into the importance of educating ourselves when it comes to our numbers. So what does financial education mean for our small businesses and why do you think it's important?
Yeah, we often hear the term financial literacy, but what does this actually mean? So financial literacy is actually the ability to understand and effectively make decisions surrounding your business, such as financial management, budgeting, and investing. So educating ourselves over the numbers can help business owners become self-sufficient so that they can actually achieve financial stability. Financial literacy is important because it equips business owners with the knowledge, tools, and skills that they need to manage their money and their business more effectively. Without it, our financial decisions and the actions that we take or don't take lack a solid foundation for success, which can have dire consequences for your business. So when people go into business, they have the skills that they need to do the tasks of the business, for example, fencing or farming, but they often don't know much about the financial side of running a business. So they're going to be faced with a whole lot of new terms that they need to learn. So in order to achieve financial literacy, they need to be able to understand what sorts of things, for example, that they're buying. Is it an asset or is it an expense? They need to know what liabilities that they have. Increasing your financial literacy will often be gradual. You don't learn it all at once. Now, your accountant is a really good place to start. When you start talking to an accountant about your business, they're probably going to use words that you don't understand. Don't hesitate to stop them and ask them to explain the words that they're using. I recall an instance quite a few years ago when I was a very new accountant. A client had spent an hour or so with the partner of the firm going over their financial statements for the last year. Now, after that hour, they came out of the partner's office and they popped into my office. Now, after the partner had left, they turned to me and they said, "Trid, can you just explain to me what they just told me, what he just said to me?" They'd spent an hour with him and they hadn't understood a word he'd said. He'd used a lot of jargon and not realised that those eyes were glazing over with that client. They didn't understand it. So it's really important that business owners build their understanding of the numbers and become more confident in dealing with the numbers and the money of their business. By increasing their own self-awareness, getting closer to their numbers, and digging deeper into how their business is performing, it can really assist them financially and becoming more financially in tune and help them understanding the difference between good and bad decisions when they came up. The lack of financial literacy can lead to a business performing poorly and owing large amounts of debt. Ultimately, it can make the difference between achieving your goals and failing. Now, in that example I just gave you, that client recognised they had a lack of understanding about financial terms and they asked for help to better understand their numbers. So many years later now, they are now successful business owners, they've grown their equity and they've achieved their financial goals. So, yeah.
Great example, and thank you so much for sharing us with that story. So now that we understand this importance of financial literacy, Trudy, I guess the next best question is, where can our viewers start?
Yeah. So quite often, clients will wait until the end of the financial year to see how they've performed once they get their annual accounts completed. And often that can be too late because you're looking in the past, maybe by 12 months in the past, and it could be 6 months after balance date. So it could be 18 months late. And it may be too late to take any remedial action. Many small business owners will base their financial decisions on their bank balance. So while we often hear the term cash is king, there's more to running a business than knowing what's in the bank. So we're going to have a look at three things today. First up, we're going to talk about reporting. Now, cloud accounting software like Xero provides you with an array of reports which will enable you to get great insights in real time about how your business is performing. So these can be run at the click of a button. But to get accurate results, of course, make sure that your bank reconciliations are up to date first. Now, we understand that there's so many reports available which provide valuable insights. However, there's two key reports that a business owner needs to understand. So these are the profit and loss report and the balance sheet. So we'll have a look at those today. Now, there's also many financial metrics or KPIs, key performance indicators, that you can look at which measure the success of the company in different areas, such as how much income are your assets generating, or even how long it takes your customers to pay their invoices. And the third thing we'll look at is budgeting. So as you may know, budgeting is a crucial aspect in planning how your business intends to receive and spend its money throughout the year, which you can then track against performance. So yeah.
That's a really great point regarding the running of reports to gain valuable insights there, Trudy. You no longer need to wait until the end of your financial year to see your results. You can actually log in daily, weekly, monthly, you name it, to really see how your business is performing. So I bet the viewers are asking right now, sounds all good and well, but how can I do this? Well, if your accountant or bookkeeper is preparing your reports using a cloud-based system like Xero, it's easy. The numbers that you are working on are the same numbers you can view in Xero. This is called a single ledger concept. So to give you some context around that, we first need to take it back to the old way of doing things, so pre-cloud-based accounting. So historically, rather than using a cloud-based platform like Xero, you would have to install accounting software onto your computer. This meant your financial data could only be viewed and updated from your computer, and then you had to send that to your accountant or bookkeeper, a backup of your financial files at least once a year. But before the accountant or bookkeeper could work their magic, they would have to convert the data into a format that works with their own system. So this old traditional approach meant you had two different ledgers that were completely out of sync and became a bit of a lengthy process. Would you agree, Trudy? This is called a single ledger concept. So to give you some context around that, we first need to take it back to the old way of pre-cloud-based accounting. So the single ledger concept is essentially the same data that you see as a small business owner will be exactly the same data that the accountant or bookkeeper will see. There's really no excuse when it comes to seeing the same synchronized data. Not just at year end, but whenever you need your advice, you can even access that same tools the accountant or the bookkeeper uses to prepare your certain reports. So as you can see the single ledger has created massive efficiencies and it allows you to really get close to those numbers. As I've mentioned before, there's really no excuse. So Trudy, just before we were talking about the profit and loss statement and the balance sheet, so before we get into that, do you care to take our viewers through each of these statements and identify some things that they could consider when looking at these?
Absolutely.
Great. So what I'll do is I'll quickly navigate through Xero and show our viewers how to get these financial reports. So first and foremost, just head into your Xero organization, land on the dashboard and click on Accounts, then pop into Reports. So as you can see here on the slides, there is an array of different reports that you can quickly run to get great insights over your business. It all just depends on what kind of information you're after, such as income and expenses information. So today, we'll just be focusing on the financial side of things. We'll first go through the profit and loss and then the balance sheet. But make sure to check the rest of the reports and tools out when you have some time.
Okay, so the P&L report, profit and loss report, will tell you how much money you have made after taking off your expenses. Your profit at the bottom won't necessarily be the same as what's left in the bank at the end of the year. This is because profit is used for a number of things. Once you've made a profit, you use it for your personal spending, your drawings. You pay tax, you buy assets, and you repay debt. So understanding how much profit you make means you can make informed decisions about how to spend that profit and meet your goals. As you all know, the profit and loss statement shows your income and expenses from the operations of running your business. It gives you a net profit figure, which is the amount of money that's left after you subtract your total business expenses from your total revenue. Now, you should know and care about your net profit as it demonstrates the success of your business. In fact, it's a far more significant figure than revenue, or the top line, as there's no point in making lots of sales that ultimately don't generate a profit. So net profit gives you an indication of the money you have available to pay the owners and or invest back into the business. Net profit will also give you a rough indication about how much income tax your business will need to pay to IRD at the end of the year or during the year. Roughly, we're looking at about 25 to 30% of your profit. Now, we've also got a total in there called gross profit. Now, this is just under the cost of sales area. Gross profit is leftover profit after selling a product or service and subtracting the direct costs associated with its production and sale. So direct costs are the business expenses that directly relate to selling your goods or services to your customers. For example, let's say you're a fencing contractor. So for each job that you work on, you need to buy the materials, hire some equipment, maybe subcontract some labour to help. These are all called direct costs. So contracts are negotiated based on the length of the fence, the materials used, the degree of difficulty, and the amount of time and labour required. On the other hand, non-direct costs are expenses that apply to more than just the goods or services that are being sold. An example of a non-direct cost might be office rent, utilities, or other general expenses, which you need just to keep your business going. So one of the quick calculations that we can do is called a gross profit margin. Now, it takes into account your gross profit and your total revenue. Your gross profit margin is important because it shows whether your sales are enough to cover your direct costs of that job and leave a margin that'll cover those indirect or other operating costs and, of course, make a profit. So let's go back to our previous example of our fencing contractor. Here, we've got contractor Joe. He's a rural fencing contractor. Contractor Joe, as you see, he's got total revenue for the year of $170,000. From that, he's got a gross profit figure of $100,000. So by dividing contractor Joe's gross profit by his total revenue, it gives him a gross profit percentage of 59%. So this means that for every dollar of sales that he generates, he earns 59 cents in gross profit before he has to pay his other expenses such as phone, motor vehicle running, insurance, etc. So that's a really good number to know. But in order to see how he's really doing with his business, we need to maybe compare to similar businesses in the industry. So he should consider looking at the benchmarks of those other industries and see how his gross profit margin compares to theirs. So now that we've covered gross profit margin, another simple calculation to look at is operating expenses ratio. Your operating expenses, as the name suggests, is the expenses that are incurred from the operation of your business. So in Contractor Joe's case, some examples could be, like we said previously, phone, motor vehicle running, insurance, maybe repairs and maintenance on his equipment, any interest on any loans that he might have for business assets, etc. So this ratio will identify how your gross profit is used. That is, how much revenue goes into funding these kinds of expenses. Now, the operating expense ratio is a valuable tool to help you improve your business efficiency. Now, for Contractor Joe, let's say that he has total operating expenses of $45,000. Now, remember, he had total revenues of $170,000. So by dividing his total expenses by his total revenues, gives us a percentage of 26%. So this suggests that he's actually efficiently running his fencing operations, and he runs a pretty tight ship overall. However, again, to really see how he's going, comparing to other businesses through benchmarking, would be really beneficial. Yeah.
Awesome. That's some great insight, especially the gross profit margin, operating expenses ratio. These help us paint pictures with the numbers that we're given. So, if you want to learn more about benchmarking, it's important to compare your results to similar businesses that provide that same goods or services. And if you really want to understand how you're performing compared to the rest, make sure to chat to your accountant or bookkeeper if you want to know more about this. And where you can find some of these benchmarking stats. Now moving on to the balance sheet side of things.
Thanks, Chloe. The balance sheet, it gives you a snapshot of your business as at a certain date. So there's three key parts that are shown in your balance sheet. The first one is your assets. So this is everything that your company owns, such as cash in the bank, inventory, buildings, equipment, vehicles. Further down, we've got your liabilities. So this is everything that your company owes to others, such as supplier bills, credit card balances, and bank loans. Then at the bottom is your equity. This is the part that your company shows your net worth after subtracting your liabilities from your assets. So assets minus liabilities equals equity. So the balance sheet is an important tool because it can help you internally guide your business decisions. It provides you with the information you need to sustain and grow your business over time, such as when you're obtaining a bank loan or other finance, or whether you can afford to be lenient with your customers when it comes for them paying your bills. Don't do that. Bringing it back to our example of Contractor Joe, to really get some valuable insight from his balance sheet, whether he can sufficiently pay his upcoming debts, we could run a working capital calculation. So this working capital calculation, it measures a company's financial health by looking at its readily available assets that could be used to pay off his short-term debt. So in short, this calculation is a great way to measure your company's efficiency and short-term financial health. So to do this calculation, we just need to know Contractor Joe's current assets, such as his cash and accounts receivable, his current liabilities, such as his accounts payable, for example. So let's have a look at this example. So Contractor Joe, he's got current assets of $35,000 and current liabilities of $20,000. So subtracting one from the other, it leaves us with working capital of $15,000. So this shows that Contractor Joe has enough assets to cover his liabilities that will arise in the short term. Now, let's say that the company wanted to obtain a loan from the bank to help purchase some other assets to improve the business. Another calculation that we could look at or quickly run is what we call the debt to equity ratio. Now, this is going to show how much of your company is financed by debt and how much is funded through your own equity. That is, how much of the business is being funded through your own contributions, such as cash or assets, or the contributions of others, investors, such as banks. So in Contractor Joe's case, he's thinking about asking the bank for a loan to help him buy a new tractor. Before he does this, let's just run his debt to equity ratio to obtain some further information. So let's have a look at his stats here. Let's say that he's got total liabilities of $70,000 and his total equity is $100,000. By dividing his debt by his equity, that leaves him with a debt to equity ratio of 0.7. Now that's quite high, and it suggests that his company is getting more of its finance from borrowing money, which increases his level of risk. So instead, he may need to think about hiring that tractor instead of buying it until he's reduced his overall debt. So as you can see, this ratio gives you valuable insights into how your company is funded, whether it's more geared towards debt or more towards equity.
Again, great insights over the balance sheet. I'm sure your viewers will be eager to open up their balance sheets and really dive deeper into their numbers now. If you'd like to learn more about financial calculations that we could run, we strongly recommend reaching out to your advisor who can guide you in the right direction based on what kind of insight you're after. Also, don't forget in Xero, you can track some of these ratios in the business performance dashboard. So make sure to check it out if you are a Xero customer. We hear time and time again, and I love this quote, that failing to plan is planning to fail. And it couldn't be any truer, especially when it comes to small businesses. I don't believe anyone sets out planning to fail, but sometimes too many priorities, not enough time, or even a lack of self-discipline results in now failing to plan, which can make all the difference between an awesome victory and a tragic loss. So on the topic of plans, budgeting is a great tool that businesses can use to understand how they're performing and keep track of this. So with that said, Trudy, from your point of view, why are creating budgets so important, and what's the benefit of businesses preparing budgets?
I think when running a business, it's really easy to get bogged down with day-to-day problems and miss the bigger picture. So successful businesses allocate time to create and manage budgets, prepare and review business plans, and regularly monitor their financial situation and business performance. Budgeting is the process of creating a plan to spend your money. Creating the spending plan allows you to determine in advance whether your business will have enough money for future projects and ensures that the business can fund its current commitments. The benefits of budgeting should never be underestimated when running a business. It helps with both planning and control of the finances of the business. If there's no control over spending, planning is futile. And if there's no planning, there's no business objectives to achieve. So budgeting estimates revenue, plans spending, and it restricts that spending. It has the effect of restricting that spending that is not part of the plan. It ensures that money is allocated to those items that support the strategic objective of the business. Now, a well-communicated budget helps everyone understand the priorities of the business, and regularly reviewing and comparing the budget with actuals can provide information that highlights the strengths and weaknesses of the business. And it helps you to align to your business objectives. So by referring to the budget, businesses can measure performance against spending and ensure that resources are available for initiatives that support business growth and development. Now, budgeting doesn't have to be hard. It can be something as simple as a spreadsheet. At the end of every month, compare your actual spending to your anticipated spending, where your money went, and make adjustments as you go along.
So now that our viewers know the importance of a budget, Trudy, who can they reach out to when it comes for that assistance with their budgeting?
Yep, absolutely. Advise people to reach out to their accountants or advisors. The hardest part of doing a budget is actually starting it. True. There's no right or wrong way to do a budget, but reaching out to your accountant or advisor will help point you in the right direction. Often we start with the previous year's figures and then talk about what you think will change in the current year. For example, you know your sales will increase by 10% because of growth. The figures then get adjusted for those plans that you have. Now, there's some great tools for completing budgets, and it may depend on what type of business you have as to which tool is best for you. Now, Figured is more suited toward businesses in the farming and agricultural industry, while Xero is more suited towards other types of businesses that aren't in farming, such as your fencing contractors or digger operators. So let's just have a quick look at Figured. This is a complete livestock, dairy, crop budgeting and production tracking tool and forecasting tool. It gives us accurate data in one place in real time. So financial planning in Figured is really user-friendly, and of course it connects right through to both Xero and your production, such as your milk solids. It gives you a really good idea just how your finance is progressing. Budgeting is really flexible, and it's not defined to just a 12-month budget. As we know, not everyone works that way. Furthermore, the planning can be quickly and easily updated as new information comes through. For example, if the milk price changes. You can store old plans and you can automatically refer back to them later on. So We've also got Figure's scenario planning tool in here. Now what that does is it allows you to look forward 2, 3 or even 5 years from now into the future, maybe with an event that could impact your business, such as perhaps buying the farm next door. The different range of plans, such as being able to expand your business for whatever reason. Okay, so other businesses that aren't farmers, for example, like Contractor Joe, with his fencing business, can easily use Xero Budget Manager for all his budgeting needs. So Xero is a great tool for budgeting, as you can choose the period you'd like to budget for, such as maybe 3, 12, or even 24 months if you wish. You can also choose to display your actual results on screen as a guide, giving you a great starting point. And of course, in true Xero style, there's a handy tool that automates the process for you. Instead of having to key in an amount for each month, you can elect to increase each month by a certain amount or a certain percentage. And then Xero will autofill the values for you based on the guidance you give it. As you can see, it's super simple, user-friendly, and provides useful insights over how business is performing against its budget. Remember us just looking at that profit and loss report? Well, with Budget Manager in Xero, once you've added your budget, you can then easily add this to your profit and loss. So this will allow you to check your actual results against your budget and help keep you accountable when making those important decisions for your business.
Thank you. Some great insights on budgeting. Thank you so much for joining us today, Trudy, and sharing your great insights from your experience and background as an accounting professional specializing in rural business. Definitely can feel that. I have obtained a wealth of knowledge, especially being here, just sitting and chatting with you, and I'm sure that our viewers have felt the same way as well. In today's day, we all need to be held accountable over our business's success, and that's why understanding the numbers is so important. And I love this quote as well, by W.E.B. Du Bois, where he said, "When you have mastered your numbers, you will in fact no longer be reading numbers any more than you read words when reading books. You will be reading meanings." So not just crunching numbers, but painting pictures with your numbers. So next time you're sitting at your computer or laptop, just log into Xero and you've got a wealth of knowledge right at your fingertips. By keeping check of this regularly, you'll be closer to your numbers in no time. Make sure to also reach out to your accountant or bookkeeper if you need further assistance along the way. Make sure also to reach out to Trudy if you have any questions and you would like to connect with the Business Results Group for services that your business may require. They're more than happy to help. That now brings us to the end of today's session. And before we do that, would you like to say a last few words?
Yeah, no, thanks Kalolo and Xero for helping us give this insight into financial literacy. Really appreciate it, and it's just, as I said, a gradual learning process, so we'll get there in the end.
Absolutely. Thank you again all for tuning in today. We hope you have taken away some useful insights, and we look forward to seeing you all at our next session, our series, Beautiful Business Powered by Xero. For now, take care, be kind, and look after one another. Kia kaha.